Let's talk about one more, a final one here, and that theme has recently taken hold, is whether international markets have been underperforming for so long that it is now maybe time to get into some of those. We're actually seeing even more tailored thematic investing, like small cap international ETF exposure. Dave, how nuanced can we get about certain places that have underperformed and maybe are expected or predicted to outperform?
Yeah, it's tough to get really excited about international as an investor because we just went through a multi-year period where anything but the US was a terrible bet. Now we're sitting here, if you look at it, year to date or since the election or really over the last year, the S&P 500 is actually the worst performing market you can pretty much find. It's worse performing than all of the core emerging markets. It's worse performing than all of the core developed markets. Now, does that mean everybody should pile in? No, we can explain that deviation. A lot of it has to do with the dollar being down more than 10%. A lot of it has to do with some international allocations themselves moving out of the S&P and back to domestic allocation. We're seeing a lot of talk in Europe, in the UK, about re-domiciling their retail and retirement assets to de-emphasize US investing. That's a marginal bid on all of those external markets and a marginal sale on the US markets. So we're going to see that kind of pressure. I think it's very tough to make the case that people should be piling into international markets and abandoning the S&P 500. But if you have an extraordinary amount of home bias, if you are 100% US invested, this is a good reminder that international diversification is good for a reason. It helps you zig a little bit when you zag like we have been this year.
All right, Tom, the last word goes to you. When it comes to international investing, are you excited about it? Is it something where you feel as though there is notable outperformance to be had, or are you going to be more measured in some of this kind of international versus U.S. type trade philosophy?
Well, I'm a stock analyst by my career, right? I start off as an equity analyst, and we have clients in 26 countries, so we visit all these countries with local exchanges. Over 95% of international markets are SMID, small mid-cap companies. Of the 25 largest companies in the world, 21 are domiciled in the U.S. There's a reason the U.S. is the sort of the marquee, most liquid market, because once you go outside the U.S., you don't find, there's not like a Meta in every country. There's not a Palantir in every country. These are uniquely American businesses. So I think that if someone's making a bet on Europe, as Dave says, it's probably cheap beta or it's a factor bet. And I don't have a problem with anyone diversifying that way. But if someone says the U.S. exceptionalism is over, so I'm going to be long Germany, that's a real tactical mistake because there's no FANG in Germany, MAG 7.
All right, so maybe even a tactical or strategic, depending on how you want to look at the size of that kind of a bet.
Yeah.
All right, thanks very much to Dave Nadig and Tom Lee for joining us here on ETF Edge. We've asked Dave to stick around for the ETF Edge podcast. You can hear it and catch all of our other installments at etfedge.cnbc.com. Thanks for watching ETF Edge. We'll see you next week.